The Fed surprised markets when it decided to keep its stimulus program in place at full blast. Markets were largely expecting the Fed to start reducing its bond buying program. Today we have with us Julia Coronado, Chief North American Economist with BNP Paribas. Julia, you were predicting that the Fed might wait until December to pull back on its bond purchases. Seems like you may be right, or are you pushing that forecast forward now?
It could be December. I think the message the Fed sent yesterday is that they are data dependent, and that's something that markets had largely overlooked in the last few months. The decision to taper when, how much, will depend on the progress in the economy. So could they taper in December? Possibly, if the data strengthen between now and then. If they don't strengthen to their satisfaction, it might be January, it might be March. But they expressed patience and flexibility and data dependence.
So in your view, it wasn't a fake out?
Again, because we didn't expect them to taper, I don't see a change in regime here. I don't see a flip-flop. I think the Fed always said, here's a general outlook for tapering, but it is data dependent. And actually the data have been weaker than they expected. They lowered their growth forecast for this year and next year. So the data do matter, and at some point the markets decided that the data don't matter and that no matter what they were going to taper.
Why is it a surprise to the market that the Fed is data driven? That they respond to the data and that they're not just
on a preset course.
Right.
It shouldn't be a surprise because they've said it, and they've said it again and again and again. And sometimes, again, markets just get set up the wrong way and they run with certain ideas. And I can tell you from working in markets, sometimes it's like an echo chamber.
So the main message then was the economy is still too weak to taper. Do you agree with that economic assessment?
Yeah, I think probably most of the benefits from QE are locked in the sense that households have refinanced to lower rates. That's helped them deleverage their balance sheets. That's good. The housing market has, we've cleared the excess supply. That's good. So probably the benefits aren't as big as they were at the beginning. But I do agree that, it would be best to taper into strengthening momentum. And it could be a confusing signal if against the backdrop of the mixed data we've seen, the Fed says, that's all we can do, folks. We're heading for the exits. That could send, a signal that could dampen confidence. If the data strengthen enough, we could taper in December, but it may be that they need to see a little more evidence, and then it gets pushed off to January, March. And by the way, we are going to get a handover to a new Fed chair at this time. And so would it be better, to let the new Fed chair make that decision? Would it be better to get it done under Bernanke's watch? I think that depends on the situation and who will be the next Fed chair.
Two big risks to the economy come strictly from Congress. First, government shutdown. And second, failure to raise the debt ceiling, which Bernanke spoke about yesterday. He said both could be significant risks to the economy. What do you believe the odds are of a government shutdown, and second, of failure to raise the debt ceiling?
So I think we're going to go right to the 11th hour again on both, and it's going to be scary at times. I think it's not in the incentive of either party to actually shut the government down. But, this is a game of chicken right now. What are the odds we actually do it? Maybe 15, as high as 20%. Still not the most likely scenario, but again, it's going to be very noisy, very vocal, and we're not going to have any clarity until right at the end.
Does that hurt job growth?
It hurts. It can hurt confidence. It can hurt clarity about what's going to happen next. It can make people take a wait and see attitude on economic decisions. And yes, that can affect the economy.